You'll like this. There's some risk with fireworks.
Really?
Did you know that? There's some risk.
I actually did.
How do
I
you
know
feel,
that very well.
How do you feel about that? Are you averse to that
I
risk? Or
I
are you okay
actually
with that
am.
risk?
I am
Okay.
somewhat averse to that risk. I think mostly because my husband is not averse to the risk, which makes me feel
Interesting.
that I need to overcompensate in my risk aversion as
Wow.
someone who's married to someone who's passionate about fireworks.
Hey, everybody. Welcome to the Advice Business Podcast. Hello, Kelsey McKenna.
Name, how are you?
I'm doing well. We're recording this. What's today? July 3rd. So, yeah, day before the 4th of July. What are you guys doing for the 4th of July?
We go to Maryland to my sister-in-law's house for a big 4th of July party every year.
What does that
So that's
entail?
where we're going. Well, my sister-in-law's birthday is today, so they do a big crab thing today,
My
and then
sister's birthday
tomorrow.
is today. How about that?
Really?
Yeah.
Happy birthday! Yeah, it's a big birthday week in my husband's side of the family. So everybody gets together. They do like a water slide usually if it's warm.
Are there any wedding crashers quotes that come out given the Maryland setting?
You know what's funny? I haven't watched Wedding Crashers that much, so I probably just don't know.
They're happening and you're just
They're
totally unaware of
probably
it.
going right over my head. A lot of jokes go just right over my head, which is funny. I feel like that's a movie I should and would like.
Yeah.
I'm gonna watch that.
there you
That's
go.
gonna go on my list.
There you go.
Take away from this episode.
That's a good plan. Will
What are
there
you
be
doing?
I don't really know. I think going to the pool and maybe a
Cool.
barbecue on Sunday, actually. Something like that. I don't know. I just sort of get told where to
Show up.
show up.
Yeah.
Will there be fireworks at your events?
But yeah, they live right in a little town that does fireworks. So if we stay over, we have little kids. So as you know, you gotta kind of stay down there. I'm not about to drive them at like 10 p.m.
You'll like this. There's some risk with fireworks.
Really?
Did you know that? There's some
I
risk.
actually did.
How do
I
you
know
feel-
that very well.
How do you feel about that? Are you averse to that
I
risk? Or
I
are you okay
actually
with that
am.
risk?
I am
Okay.
somewhat averse to that risk. I think mostly because my husband is not averse to the risk, which makes me
Interesting.
feel that I need to overcompensate in my risk aversion as
Wow.
someone who's married to someone who's passionate about fireworks. This
Very,
reminds
very.
me of something.
This is so interesting that you say that and that there's some, dynamics there even within the household.
Do you do
Why-
fireworks? Are you
no.
You don't seem like you would be like a
No.
fireworks guy.
Yeah, no.
You know, some guys are fireworks guys. Like you can tell.
Yeah, no, I'm not a fireworks guy. Maybe as
Yeah.
a kid, going to actually to Pennsylvania, driving
Yeah,
across state lines
Pennsylvania.
to pick some up.
You can definitely get fireworks here.
Well, why do we care about this risk aversion or not idea? Why have I dad joked that into this
That was
podcast?
a great intro.
Thank you.
Because today we are rethinking risk. We are just going to talk all about risk and how we believe. Well, we'll fight about this. Who knows if we are really that aligned here, but what we think needs to change in terms of how risk is measured in this industry, in the wealth management, financial planning industry. That's what we're going to
Yes.
talk about today. So that was a great, smooth intro. That was actually one of your best. You're like a real podcaster now.
Thank you.
It
Totally
was a
off
very
the
dad
cuff.
joke, but it was great.
Yeah, I appreciate it.
So you have a ton of opinions about this. So
Yes, I do.
I will kind of like be the facilitator
Keep me on the
of
rails.
your opinions. Yeah, I will try to get you to be able to share your opinions concisely and also like kind of poke around on some of the stuff around engagement and, the way things are traditionally done versus how it might change in the future.
Without
so let's
getting
do
us in
it.
trouble somehow.
Hopefully. We'll see.
Okay, I love it. Let's do it.
Let's do it. And we're gonna keep this tight. We're really good at keeping things tight, so I'm sure. So I'm sure it's gonna be really short. Okay, so first we're gonna talk about like the history here and some of the flaws regarding traditional risk tolerance questionnaires and using those risk tolerance questionnaires as a primary driver of the asset allocation. So maybe you could just start. I'm going to put you on the spot here. I'm definitely not doing this part, but why don't you go through kind of the history here and the traditional use of risk tolerance or emotional tolerance in portfolio design?
I'll actually jump to what I think we see the situation, how we see it today, which is, we talk to lots of advisors all the time. And I would say most of them, and there may be some sort of confirmation bias coming through here, but I would say most of them agree that trying to build your client's portfolio based on this difficult to measure idea of someone's emotional tolerance for risk is generally not a great idea. So that's pretty interesting given the fact that, think of the dichotomy of that's what most advisors, at least anecdotally, we talk to, and I do think there's a bunch of research to back this up, don't think it's a good idea to use it. And yet that's been sort of the underlying premise of how to build portfolios across the industry for some time. So to answer your question on the history of that, I think it's based in the regulatory environment that really required it. Essentially, it was, part of what you needed in the eyes of the regulators to understand and capture. And I do think to a certain extent that was conflated with the idea of, therefore, here's what the portfolio exactly needs to be to reflect that number. So it's interesting, I think something that is so prolific, so common, so much the status quo of how advisors up into more recently have understood investors and connected that to a portfolio outcome, seems like everyone's sort of agreeing to a large degree that arguably was never right, but now it's sort of time to move away from that.
A question. Maybe, hopefully you did your research because now I have questions now that we're getting into the conversation. But I'm assuming this came about before planning was really like a core part of the service offering, because in my early days in my career working in planning tech, we would take a ton of calls and get a lot of questions about kind of marrying the investment portfolio to the plan. And I'm just curious, did the need for the risk tolerance come from the fact that it was not based in anything else? And so what should it be based on, and trying to create some sort of standard, from a regulatory perspective? Does it predate that shift in the industry? And it's just kind of one of those things, because if you think about it, and we're going to get into this more, but if you have the plan, regardless of the tolerance, whether you measure it or you're just kind of vibing it with the person, that's still somewhat of a trade-off conversation no matter what. You know what I mean? So I'm curious if it predates that shift.
Yes, it does, but the sort of facilitation of capturing it and was really in parallel with the proliferation of holistic financial planning. So it's kind of interesting that I think the answer to your question is yes. But then as it really, as financial planners, true financial planners doing financial planning, you go back, 15 years ago, or even before that existed. And yet sort of the proliferation of using tolerance as the basis for asset allocation was kind of going up in parallel. I'm sure that's a pretty imperfect analysis, but I think that's roughly correct, right? As planning was increasing in being a service offering that more and more people were delivering. So you're exactly right. The fact that those things really just continued to not be connected, and I think, and maybe I'm jumping ahead here, but a big part of the reason for that is because of the simplicity that comes from a singular score tied to a specific simple outcome. So, the planning and needing to do a deeper holistic financial plan in order to determine more nuanced portfolio creation has its complications for a bunch of reasons. And so that tolerance number is a simple number to capture and tie to an outcome. So I think there's a lot of moving pieces to this, but that sort of simplicity and let's say, the technology empowerment of advisors to capture that simple concept and tie it to simple outcomes fed this beast a little bit as well over the last, decade plus.
Yeah, I just quickly Googled it while you were talking. And it looks like they've been around, but gained popularity in the 80s is like the rough summary. So that seems aligned with what you're saying.
I like this real-time fact checking.
Yeah, this is
I
how
like
this combo is gonna go. Buckle
Good.
up.
I like it.
So, because I want to make sure that like we're not just creating like an echo chamber here of like our own thoughts. You know what I mean? So like let's Google too. So basically, then I think if we want to turn a little bit to, so there's the whole piece of this of like the trade-offs with financial planning, but then there's also kind of this idea that it has been swirling around of like we need to know who, like we need to make sure that they're in a portfolio that has low enough risk to make sure they stay in the portfolio over time. So whenever markets fall or there's volatility, will they be comfortable staying in? And that's kind of been like the core driver of a lot of this, which I find interesting in comparison to how much you hear in general advisors shifting someone's allocation or shifting the strategies within an allocation. So I'm just curious your thoughts on that whole piece of this of like, does it really keep people in their portfolio? Like to be tagged as like a risk level 4 and then you're put in a risk level 4 portfolio, does that keep you there if you do have low risk tolerance? I don't know if you've looked at any of the research there.
Some of the research we've looked at suggests that the answer is not so much. So, in other words, if your focus is to appease a risk averse, someone who emotionally is indicating when you first meet them that they can't withstand market volatility, whether they're in, unless they're not in capital markets, right? Unless they're in cash, the second you start to layer in any risk exposure in an allocation, there's not much of an emotional delta between, let's say, a 40-60 allocation and a 70-30 allocation. And so now on the inverse, and we'll kind of, again, I'm jumping ahead a little bit. On the inverse, to have somebody in a 40-60 when they need the risk exposure of a 70-30, and so therefore you're making this trade-off decision to appease the expressed emotional unwillingness to take the risk, you're actually not solving that problem, to your question. So you're kind of losing out on both. You're not actually
and define
achieving
risk too. Like I think this is with risk tolerance questionnaires, it's viewed as a very narrow definition of risk. It's really truly specific to like the portfolio allocation or the asset allocation of the household versus in general the risk of not meeting your goal. Like there's so many other things. Like for someone, what I constantly think about is like for someone who does have a low risk tolerance and is nervous about volatility, think how much more nervous that same personality will be 40 years down the road
not having enough
when
money to
they don't
live
have
on.
enough money, and then the money that they do have still has to be in capital market. Like I just don't, I'm just curious about like the whole how advisors are navigating this, and we do spend a lot of time talking to advisors about this because we have a risk assessment in our tool. So I have a ton of feedback, and I've heard a ton of examples of this, but it kind of goes back to that question of like when you do rely so heavily on emotions to drive the allocation, what are you really solving for? And my initial gut reaction when I ask that question is comfort. But then it's really not comfort, because to your point, compared to what? You only have one portfolio, you only have one asset allocation at any one given time. So it's not like if I have a low risk tolerance, I'm comparing this to my other portfolio with my other advisor necessarily. You know what I mean? So my 40-60 versus someone else's 60-40 will still feel volatile to me potentially.
That's exactly right. So you're not only missing, you're not only not appeasing in the moment of market volatility, really, and fundamentally you're pushing worse emotions, real problems down the line. So if you can't, this past April, there was significant market volatility. So someone where you've appeased and put them in an asset allocation driven by their emotional feelings around taking risk, they're still worried. They're still concerned because that's That's their underlying fear. But they'll be a lot more worried 30 years from now that they could have / needed to have achieved a much more significant return profile to live happily in a lifestyle that they want in retirement or whatever they want their future to look like. Those conversations are going to be a lot harder than the point in time conversations when markets go a little bit wild for, a month, a quarter, a year. And yeah, I think that is it's a really good question, because it's sort of a kick the can thing that, advisors maybe are just accepting, and, we'll deal with it when we get there. And I think that's a big part of this. Like, when do you fundamentally address a disconnect between tolerance and need? And we believe and talk a lot about day one's probably the right day for it, not when they're, the day they're trying to retire and have underperformed what they needed to do in their portfolio to go live the lifestyle they want. So yeah.
And I mean, of course, there are trade-offs on the planning side that can be taken too, which is what a lot of advisors end up needing to do is, okay, we can only take this much risk in the portfolio, which means we need to adjust other inputs. We need to adjust retirement age or spending or, any of those dynamics that would come into play when you're actually running the plan. So there's also that piece of this. And all of this is really kind of a nuanced trade-off discussion that can be had. But that's why I think like what you're saying around us trying to kind of pull these two things apart and say, okay, there is a number, there's like a mathematical number of that can be tied to the risk you need to take. And then there's also your tolerance number. And it's not to say that tolerance isn't important. It's just, should it be the driver of should it be the thing that is driving the allocation and the thing that we point to as the reason why they are allocated the way that they are? So maybe you could talk a little bit about how we are now approaching risk, because we haven't always done it this way. To be fully transparent, we've always talked about and coached around risk need versus tolerance, but have recently made a more significant product update around this to make it a lot easier. And this is based on feedback with a lot of our advisor customers and prospects about separating those two numbers out and really trying to, over time, help advisors drive better relationships by understanding those numbers and how they are different or similar.
Tolerance is truly still important to try to understand if you're going to manage someone's money. And so we're not saying don't try to capture an understanding around their level of tolerance. You should. But you should also know that point in time assessment of their tolerance is the toughest thing to quantify and have confidence will stay that way for any measurable amount of time. So how people are feeling that day, given externalities, when you're assessing them for the first time in your discovery process, is not a sustainable, hard fact, right? It's very, very, very imperfect output. So it's a delicate balance, right? Yes, you should try to capture it, but understand it's incredibly hard to measure. But separate from that, what do you need to achieve in a portfolio? What risk-adjusted return is necessary across what period of time to achieve your short and long-term financial goals? Mathematically, that is all that matters in how to construct the portfolio. So if you completely strip emotion out of the equation, that's all that matters. This is math. What return do you need to get? What's the best way to achieve that return to achieve your goals? Period. So if you get these two numbers, you said it a second ago, it gives you a framework to actually discuss trade-offs. If you feel a certain way about risk, let's say you don't want to take risk, you're really risk averse, you're worried about volatility, or at least in our assessment, that's what you're indicating on the day we're having this conversation. But you need to take a lot of risk to reach the goals you're trying to achieve. I now have two lines, I have two numbers, I have two measured things as a framework to discuss what are we going to do about it. You can't do both. You can't bury your money in the backyard and get a 7% year over year return that you need to achieve to retire when you're saying you want to retire, and live on the money you're saying you're wanting to live on in retirement. So again, on day one, let's talk about what trade-offs should we make on that basis. And I think a lot of times advisors feel like they're in this unfortunate and uncomfortable position of trying to solve both at the same time without actually making any trade-off decisions, which is mathematically impossible. It's just the reality of, unless something magic happens and, the most conservative...
for clients where there is a big misalignment, yes.
If cash can somehow yield that higher return forever across the next 30 years, let's say, of the client's life to achieve the goals, and you take very, very limited risk, and somehow risk and return are no longer inversely related to each other, these are mathematical realities that you need to work out with people on day one. So that's what we believe and have a lot of discussions with advisors about. Capture the two numbers and then have that trade-off discussion of what are we going to do about this? How are we going to square these two things?
It's funny. I don't know why I didn't make this connection before we started talking, but we've had a lot of conversations internally at Seeds recently about business risks and prioritization around business risks. So one of the things that's interesting that we've been talking a lot about is that it's not about eliminating all risks. It's about understanding and accepting those risks and acknowledging them and doing whatever you can to make sure that you are prioritizing the highest risks, right? So that just popped into my head while you were sharing that, because there's also this, I think historically, and we've talked about this on the podcast before, but this idea around, we don't really need to educate our clients. We need to measure and math our clients, and then we need to apply our knowledge and tactics and products and things to their life to help them reach their goals. And I do think in that world, if that's how you see it, of course, stamping a risk tolerance, questionnaire on something is probably a good idea, because your clients are not really ever going to understand and be able to accept the risk that they must take, or to make any informed trade-offs to reduce the portfolio risk, or to reduce the risk that they retire or can't retire ever, or without enough money. So there's this idea, I think, that this ties back into education and ties back into the planning conversations in a really it goes back to our conversation with Melissa about how do you educate without being condescending or treating it as a marketing tactic? How do you genuinely have conversations with your clients to educate them about their financial situation and what their options really are, so that they can knowingly be comfortable and accept the risks that they must take? Because like we said earlier, there's risks no matter what. You're having to make trade-offs no matter what in almost every case. So,
well, it goes back to, I think most clients generally appreciate truth and clarity. Mm-hmm. And using this moment as an opportunity for real truth and clarity, as opposed to this, I'm going to understand this emotional feeling you have about taking risk, but not put it in real context about what that therefore means for your long-term financial security, and kind of kick the can down the road of having review meetings about market volatility, as opposed to that disconnect between the feelings and the facts of your financial plan. And that it is that educational moment that I think, when framed the way we're describing, people appreciate that truth and clarity. We want to understand how you feel about taking risk. It is fundamentally important. We want to discuss it. We want to unpack it. But I think also a lot of people are logical too. They understand when you frame up the other side of the coin. Okay, we understand how you feel about it. Here's the mathematical reality. And again, I think what's so exciting about it too is just that feeling of ultimately then being on the same page with the person whose money you're managing on day one, right? Because every time when you don't do that, and you go into these, talking to your clients about volatility when the markets are volatile, you have nothing to point back to about why they're in the portfolio that they're in, right? If you didn't have that conversation on day one, then it just becomes about talking them out of moving money into cash, as opposed to why are we in the portfolio that we're in on the basis of the thing that we agreed to 3 years ago when you became my client and we were on the same page about. And those are two obviously completely different conversations when you get into those moments.
Yeah, and I think like getting into it a little bit more in terms of like how it can drive engagement, similar to every other thing that we measure in our assessment today. The real easy win here in my mind from an experience perspective is just giving you the ability to say back in a very concise and meaningful way that is tied to action on the other side, to say back, this is what I'm understanding. And this is going to tie into what we're going to talk about with couples, which I'm very excited about and is one of my favorite topics. But I think this is one of the easiest, in terms of my conversations with advisors, this is one of the easiest jumps to make in terms of like, I just really want to improve how my clients feel as we are going through discovery and as we are going through kind of early onboarding with them. I want to improve how they feel. I think this is a huge opportunity because it's a very simple, just little shift that you can make, and it can have a very meaningful difference in terms of how you approach the conversation with the individual or with the couple, which I think is awesome. And I think it does bridge to planning a lot better and kind of helps solve that issue of like, I have my planning service and then I have my investment management service, and those two things are tied together in my mind, but they are not necessarily completely tied together in my client's experience of interacting with me. Basically, like it is really the bridge there. So I wanted to get into clients, but I just want to like highlight that for folks listening, that like this can be a very simple shift in how you talk about the portfolio, how you talk about the findings coming out of your discovery process, that can really make a big difference.
Yeah, they can feel heard on the emotional piece, but again, I think it's about getting them appreciating the truth and clarity and being on the same page about the need side of the equation. And then having those real trade-off discussions on day one. So here's where you are from a tolerance perspective. And let's say, your need is dramatically higher than that number. We can build a portfolio around the tolerance number as long as we understand that the outcome may not achieve what you're saying from a planning standpoint you're trying to achieve. And at the end of the day, that may end up you may end up constructing a portfolio to some degree somewhere in the middle. An encouragement, though, if you aren't actually having the client commit to trade-offs and really understand where they may fail in, as you push out those projections longer term for them, that if you build the portfolio in the middle, if you say, okay, your tolerance is a 2, just to use the most extreme example to make the point. Let's say your tolerance is a 2 and your need/capacity is a 10. And then I build a portfolio. Let's say I build a 5.5. I build roughly in the middle. I will not appease, back to the earlier point, I will not appease the emotional piece when there's market volatility. And I also won't achieve the outcomes that they're saying they want to achieve. So that has to be, those dynamics there has to be, this is the opportunity, to your point, to achieve that mutual understanding on day one. It's math. There's a trade-off discussion. We can build around feelings, we can build around the math, and let's be on the same page exactly as to what that's going to look like long term.
Yes, exactly. Which I think kind of segues nicely into this conversation about couples and where we kind of hope to see this going for more and more and more advisors. So one of the most beautiful things about changing and shifting how you think about and measure risk in this way is that it allows for there to be commonality between two people who are sharing their financial lives. And that commonality can be the need number. Hopefully, in most cases, they're running at one plan and that plan has a specific need across all of the assets and the whole portfolio involved or whatever, right? The tolerance can be different, and we can treat these two individual people differently, and we can talk through both of their feelings separately. Whereas before, if we're looking at, here's our risk tolerance for each of our clients, right? the way that that was, even like in my old planning days, the way that this was actually like brought to life was like, okay, here's the risk tolerance for this household that we're applying to this plan. That misses, there's so much that is missed in doing it that way. And it's no wonder, it's just one of those little tiny paper cuts that has been like the death of like how we serve couples in this industry, in my opinion. But like the fact that you don't even know the more like quiet spouse or the less involved spouse's tolerance compared to the primary contact or the whomever it is that you're actually interacting with mostly is a huge gap. You don't know, it maybe the tolerance of one spouse is really high and markets are volatile and you're like, sick, that person's good to go. We don't even need to worry about them. Their spouse could be freaking out and could be
Yeah.
resenting their more tolerant spouse, their more risk tolerant spouse, and the advisor as the markets are swinging wildly up and down, right? They could be sitting there in resentment and you have no idea and you would not even know to reach out, right? So this is a huge opportunity that I'm really excited about to just really shift the best practices around this all together and to help advisors in a more streamlined way that is not going to be a burden to them understand where to spend their time throughout the year and throughout ongoing connection points with clients. So I would love to hear your thoughts on this as someone who is an advisor. I've never actually been the one giving the advice or having those conversations, but in terms of what I've heard from clients who are doing it, I think it's really powerful.
We'll end up doing a whole episode on the topic of the fact that as an industry in general, we're not consistently engaging household members. It's predominantly one member of the household and all of the problems that come with that. But since we're talking about, risk tolerance, risk need, that is, as you're describing, sort of like the most obvious entry point to how to engage at the beginning with, spouses, let's say, and to understand how each feels where there may be a unified need. I'll use a real life / fake example to kind of highlight this point, right? So let's say as a firm, it's been most common that you're engaging one of the spouses in your sort of discovery and onboarding experience. And you determine through your risk profiling that the person you're talking to has a high tolerance for risk. So we can sort of inverse some of the examples from earlier. So high tolerance for risk, but they actually have a lot of liquidity, post-retirement, they've got plenty of money to live on for the rest of their lives. So they don't actually have a high risk need. They want to die with no money left. So all the cash flow planning says they're in great shape. Basically, they could bury their money in the backyard and no issues. Primary person you're talking to, high tolerance for risk, low need. Maybe the spouse you're not talking to has a low risk tolerance, has no interest in taking risk because it doesn't make sense, because they don't need to take risk. But you build a portfolio around the only person you're talking to in the household. And so you appease the high risk tolerance gambler type personality and build a portfolio with high stock concentration and maybe even some wackier stuff in the portfolio to appease and maybe even to win the business. And then a year goes by and something like this past April happens and you get a phone call from the other person you've never spoken to before saying, I'm looking at our accounts. Why are we in all of these stock positions as the markets are imploding and now putting our nest egg at risk when didn't you show us didn't you show my spouse that we didn't need to take that risk? Those examples, I think, are happening across the industry constantly, and it's such an unforced sort of silly error, and inversely, such an opportunity. And anecdotally, we've heard even from some users of Seeds recently that doing this assessment experience with both household members has been the unlock, has been the thing that, we even had feedback of a spouse recently saying, wow, previous advisors have never even asked me any of these things. And so not only is it probably pretty important to deepen relationships and, win business on the basis of that. But it's pretty important in terms of how you're going to build the portfolio for these people. And so those dynamics can be captured, right? You're adding this layer of need versus tolerance, and the fact that there may be more than one person who has feelings about the tolerance piece, even if the household is aligned on the risk need, and presuming they're married and their sort of financial plan is meant to be built around them. And so, and of course, we can spend, which we won't, but more and more time on the other things you can capture when you're actually assessing both people. How they feel about things like values alignment, how they feel about things like different areas of the market to invest in, general mindset about investing, what they feel like they want to be educated about or could care less about, or somewhere in the middle, and so on. So there's a lot there. And so we're excited, to hopefully be helping with that more and more.
Yeah, for sure. So to kind of like, I guess, close this conversation down and we'll wind down here. What do you think is next for us, like product wise here? So we've split tolerance and need apart. So we're now measuring both of those. We can assess both client and spouse on these things. Where do you kind of see this going roadmap wise? I already know the answer to this, but for listeners.
Well, yeah, I'm not sure what you're thinking, because I have sort of two sides. Two answers, two paths. So one is everything around the engagement and experience of understanding these things. So on the tolerance side, on the need side, when you have even if you have one person, but if you have a married couple, how are you building portfolios? So I'll give an example. Spouses may be aligned on, let's say they're perfectly aligned on need, presumably, and tolerance. And so in their IRA accounts, to keep it simple, the allocations will be the same, because from a goals standpoint, they're aligned. From a tolerance standpoint, they're aligned. But let's say one of the spouses really is motivated by something like values alignment. Okay, great. We can bring that to life in a portfolio, whereas maybe the other spouse, that's less important. And so you have these sort of layers of personalization that can be brought to life in the portfolio itself, and then, of course, in how you're engaging them. The other piece of this that maybe be the answer you weren't thinking I was going to share is, how do you more deeply quantify and convey that allocation based on the need is the thing that is proving itself out across time? So as goals are captured, as goals change, is this the portfolio allocation that is mathematically reflecting that need? And I won't go down the rabbit hole, but I'll throw out a maybe hot take opinion. There's a industry paradigm where either, and this is like wildly painting with a broad brush, but either you're building portfolios based on a tolerance score, right? You're doing a risk tolerance questionnaire, and then you're building an allocation. Or you're spending 6 months to do the most comprehensive, deep financial plan before you surface an appropriate allocation. And so trying to solve the middle ground there, because, by the way, 6 months goes by and the markets start going down and they're still DIYing their portfolio and they sell to cash. It doesn't help that you've spent 6 months building the financial plan to figure out the allocation. So that middle ground of what is the math, what is closely the realistic, appropriate need to build an allocation that, of course, deep, further comprehensive financial planning can validate. You can run as many Monte Carlo simulations till the system burns out as you want, but getting people allocated appropriately based on a need score. And so having our system really be able to convey that. So those two areas: engagement based on all the information you capture in the assessment, and then the sort of refinement of that need score and portfolio allocation.
Yeah. No, those were the two that I thought you were going to bring up. So
wow.
We were very aligned. The thing I'll add to the engagement side of this is just to be very clear, also surfacing insights and opportunities over time to kind of provide more value or to touch base based on these factors. So it's kind of inherent in what you're saying and building the portfolio and engaging, but just to be very clear, I think having like advisor client base level insights around who is in your client base and what is the disposition of your client base across all these different things we're measuring, but then also who should you be reaching out to and what should you be sharing or talking about this week and how should you be approaching those conversations, I think is a really big part, but it ties into the piece you're talking about, which is how does this connect to planning? There are a lot of firms we've talked to recently who are in growth mode. They're very successfully growing, who are essentially doing a very light version of a plan to validate that need number, even though they are measuring tolerance. So what has been really, I think, interesting is to come across so many firms who are kind of with a very clunky manual process, piecing these things together. So I think that streamlining of that process and the ability to kind of loop back on the story every time you meet or any time is needed, I think is the where these two things come together of like, how do we tell the story of need and how do we tell the story that you're on the right track and that you're there without doing every single update to the financial plan? And then who do we tell that story to and when do we tell that story and in what level of detail? So the marrying of those two, like the bridge between investment management and planning meets engagement and insights that are driven by a deeper understanding.
One little sub example, and then we'll land the plane. A lot of times we'll see too, if you're really building out the deep comprehensive plan, 3 months of a financial plan to determine an asset allocation, I've seen too where you're also doing a risk tolerance questionnaire. And so you just made this point, but the fact that they are therefore sort of like emotionally disconnected concepts to the client. So it's like, why am I doing this risk tolerance questionnaire if you're not giving me a portfolio that makes sense until you do this whole comprehensive, deep dive financial plan, which is great. Like in a vacuum, that's not a problem. But if you're doing a risk tolerance questionnaire, the client's not stitching together those concepts. And so really trying to bring them together, again, back to the earlier points, so that they're framed in the mind of the client the right way, and you get to that trade-offs discussion. Speaking of trade-offs, so we started this about fireworks. You are risk averse on the fireworks front. Your husband's the opposite. The need score would be high because it's the 4th of July. So who's winning that debate?
I mean, he always, I don't know if he's winning the debate, but he just goes and buys fireworks. We're in Pennsylvania. When we lived in California, that wasn't even an option. So we didn't even have to fight about this. But now fireworks just appear in our house. So the compromise is in how we do fireworks here. That's the compromise.
And you'll have
who gets to be outside while the fireworks are going off? Who's watching from the window?
And you'll have a good fireworks advisor to facilitate that discussion.
Hopefully.
Just to really mess up the analogy.
Yeah, there you go. Well, do you want to land the plane?
We'll land the plane. Did we miss anything?
I'm sure we did.
Okay.
But we're over time per usual. So
yeah, we got to get to the fireworks. Thanks, everybody. Yeah. We appreciate it. If you haven't checked out Seeds, www.useseeds.com. We'll see you next time.